Well, it is a big day, and it is all about the Bank of Canada. But before we go to our first guest of the morning, just want to highlight we are getting the data out of the Canadian Real Estate Association on existing home sales for the month of June. They rose 0.8% in June, a tempered level of activity versus the 3.1% rise in May. All of this data will be folded into what the Governor of the Bank of Canada is thinking in terms of the activity level. Also, those manufacturing data points we saw this morning that remain under some pressure. Just with that CREA data, I want to make sure that I get the number, and it is down 0.8%. I misread that versus May, which was up 3.1%, so a little softening in activity in existing home sales in Canada. The Bank of Canada's interest rate decision looms. Should they cut? Should they not? We're joined now by Diana Avigdor. She's Vice President and Portfolio Manager at Barometer Capital. She is at the TSX. Good morning, Diana.
Good morning.
The markets, the futures markets are saying it's a 50-50 chance of a cut. Where do you sit?
The one thing for sure is that rates are definitely not going up in Canada versus the U.S., where they are definitely going up. It's just a matter of timing. In terms of what happens actually today, not sure. I think that it's important to note that the interest rate sensitives, such as the housing and so forth, they're not suffering. I'm personally a believer that Canada should allow for more time to pass. We do have our largest trading partner clawing out and slow growth with the rates poised to go up. And whether it's this year or next year, that is a timing question, but it's the speed of the rate increase that matters. And I'm of the belief that a quarter point increase is actually a good, in the U.S., is a good indicator that things are getting better. And when things are getting better there, eventually, as our largest trading partner, we will see some benefits, albeit probably takes a quarter or two. So, our housing market may get a little hotter if rates go lower and our Canadian dollar even weaker.
I guess we got a number of moving parts in this Canadian economy. But I wanted to talk about oil, but you just said something interesting to me in terms of the housing market. So if they cut, maybe there's more enthusiasm for housing, but that's going to put pressure on the Canadian dollar. And we were talking about this earlier in terms of, there is a discussion point here in terms of who's buying some of these houses, and some of them may be foreign entities. That may offset some of that enthusiasm for real estate if that dollar falls.
Well, that may possibly be true. I don't know how much. First of all, you can hedge the Canadian dollar for those that are buying big ticket items for investment. We as asset managers, whether we invest in equity markets or real estate or any other businesses, we can temper that Canadian dollar weakness. But important is that we offset our energy exposure on the macro level with the manufacturing, hoping that it'll offset some of it. In the weaker Canadian dollar, I think more than will offset our ability to export and get a little more efficient on that front. Because let's face it, on the energy sector, we have a lot of supply sloshing around and a lot of new producers and a lot of new oil coming in. So we must diversify our economy. I do agree with you, though. There is a risk in the bubbleness of the housing market as it relates to foreign investments. But that can last for a little while longer, and I'm not sure that it actually gets poked because of the foreign investors. So I think the manufacturing side is very, very important. But again, I do think that you don't need a rate cut in the face of a rate increase in order to, make our Canadian dollar a little more attractive relative to the U.S., as the U.S. dollar is poised to rally going forward as well.
Ground zero for activity after a rate move is usually the Canadian dollar, but in this case also it may be the Canadian banks. They could find that their net interest margins continue to contract if indeed they have to follow along in terms of prime cuts and the like, and rates going down. How do you play the Canadian banks here?
We have very little exposure in the Canadian banks. I think that the Canadian banks are attractive only from a yield perspective, and they are stable. For those investors that are not able to leave the Canadian equity market and gain exposure elsewhere. At Barometer, we have a high financials exposure, and we've been discussing this for a little while, but it's in the U.S. We do prefer the U.S. banks. They do have a few more things that work for them. Their NIMs, we've seen with the banks that have reported that the net interest margins have done well. The ROEs are up. Their housing market is not as exposed to high prices yet. Their energy, their diversification is better. So Canadian banks, I think they will have a type of a barbell. They haven't seen any weakness out of their oil or energy exposed loans, and they still have decent mortgage numbers and a very nice yield. And you don't take a currency risk, but in this case, a U.S. dollar is not really a currency risk at this point. So how you play the Canadian banks, it is the safe, diversified non-energy trade in Canada if you must stay within.
You mentioned the U.S. banks. Bank of America reported, and you mentioned NIMs. They were up about 10 basis points at Bank of America, and costs are down, headcounts are down. The stock's up, let's call it 2.5% this morning in the pre-market. I got a sense that these banks, U.S. banks, might be in a bit of a sweet spot run.
Exactly right. It's been a long wait for them to start pulling in some quarterly numbers that are working in the right direction. But I think one of the things that you notice here, last year they had $4 billion in legal expenses. This quarter they had $175 million. You can see that one of the costs that has really dragged down these banks have been litigation expenses related to mortgage issues through the financial crisis. As their balance sheets has been cleaned up, as the regulation and themselves catch up with what, the cost cutting and the legal issues need to be ironed out, their mortgage originations also increased quite substantially this quarter. So the housing market there is in a different cycle than where Canada is, and so that provides an upside for them. It's starting to all work in the right direction, and we've seen that with the three banks that reported so far in the last couple of days.
Dana Avigdor, have a great trading day.
Thanks very much.
She's Vice President, Portfolio Manager at Barometer Capital.